The world is richer than ever on paper. Governments celebrate record growth. Markets reach historic highs. Gross domestic product keeps climbing. And yet most people feel poorer, more anxious, and more constrained than a decade ago. This is not a paradox. This is not bad luck. This is not a temporary phase. This is how the modern economic system works. Growth is no longer designed to improve your life. It is designed to stabilize markets, protect assets, and sustain debt. If you feel left behind, it is not because you failed to keep up. It is because the system moved on without you. Tonight, we are not asking whether the economy is growing. We are asking who that growth is actually for. Economic growth has become one of the most misleading concepts of the modern era. Headlines announce expanding economies, record-breaking gross domestic product figures, and historic market highs. Yet for hundreds of millions of people, daily life feels more constrained, more fragile, and more expensive than ever before. This contradiction is not a coincidence, and it is not a temporary anomaly. It is the result of how growth is measured, what is counted as success, and whose reality economic statistics are designed to reflect. Gross domestic product was never meant to describe human well-being. It was created in the aftermath of the Great Depression and the Second World War as a tool to measure industrial output, production capacity, and national mobilization. In an economy dominated by factories, physical goods, and wage labor, this metric roughly aligned with living standards. When production increased, employment rose. When employment rose, incomes followed. Consumption expanded, and societies genuinely became richer in tangible ways. That historical context no longer exists. Today, gross domestic product grows even when societies do not. Financial transactions, speculative trading, asset revaluations, legal services, administrative costs, and debt restructuring all add to economic output without creating new material value for households. A hedge fund executing high-frequency trades contributes more to gross domestic product than a family receiving affordable housing. A surge in healthcare prices increases economic output even as access deteriorates. A housing bubble inflates national wealth on paper, while pushing ownership permanently out of reach for younger generations. Modern growth is increasingly detached from production and anchored instead in valuation. When stock markets rally, when real estate prices surge, when corporate balance sheets expand through leverage, the economy is said to be growing. Yet these gains are not distributed evenly, nor are they accessible to the majority of the population. Ownership of financial assets is highly concentrated. The top segment of households controls the overwhelming share of equities, bonds, and income-producing property. When asset prices rise, their wealth compounds. For everyone else, rising prices translate into higher rent, higher insurance costs, higher debt payments, and reduced purchasing power. This structural shift explains why growth feels invisible. Wages in many advanced economies have grown slowly in real terms over decades, despite continuous expansion of output. Productivity gains no longer flow primarily to labor. Instead, they are captured by capital through automation, outsourcing, and platform-based business models. Companies scale without proportional increases in employment. Profits rise while payrolls stagnate. Gross domestic product celebrates efficiency while workers experience insecurity. Global economic data reinforces this divergence. Over the past decades, world output has multiplied, yet median household wealth in many countries has barely moved when adjusted for inflation and housing costs. In some regions, disposable income growth has failed to keep pace with basic expenses such as shelter, healthcare, education, and energy. Growth exists, but it is layered on top of rising obligations. People earn more nominally while being able to afford less. Financialization is at the core of this transformation. The economy increasingly rewards the circulation of money rather than the creation of goods. Corporations prioritize balance sheet optimization, share buybacks, and mergers over long-term investment. These activities inflate valuations and earnings per share, directly boosting gross domestic product, while doing little to improve productivity or wages. Entire industries are built around extracting fees, interest, and rents rather than producing tangible value. Even government spending contributes to this illusion. When public budgets expand through debt-financed programs, gross domestic product rises regardless of efficiency or outcome. Administrative expansion, compliance costs, and emergency interventions all register as growth. Whether these expenditures improve living standards is secondary to their statistical contribution. Economic expansion becomes a measure of activity, not progress. The disconnect is also geographical. Growth concentrates in financial hubs and asset-heavy regions, while peripheral areas stagnate or decline. National averages hide regional decay. A booming capital city can offset collapsing rural economies in the data, masking social fragmentation beneath a single positive number. Gross domestic product smooths inequality into invisibility. Global institutions, such as International Monetary Fund, continue to rely on gross domestic product as the primary indicator of success because it aligns with debt sustainability, capital flows, and market confidence. A growing economy appears more capable of servicing obligations, regardless of how that growth is distributed. From a financial stability perspective, the number works. From a human perspective, it increasingly does not. Media narratives reinforce this distortion. Economic reporting prioritizes market performance, quarterly earnings, and headline growth figures. The lived experience of households rarely fits into these frameworks. Rising employment counts ignore underemployment and job insecurity. Wage growth statistics ignore the erosion of benefits and purchasing power. Inflation averages obscure the fact that essential costs rise faster than discretionary spending. Growth becomes a story told to markets, not to people. The result is a society that is statistically richer and experientially poorer. Growth exists in spreadsheets, valuations, and forecasts. Poverty exists in crowded housing, financial anxiety, delayed life milestones, and dependence on credit. The economy expands upward while stability erodes downward. This is not a failure of measurement. It is the outcome of choosing a metric that rewards scale over distribution, activity over welfare, and capital over labor. Gross domestic product grows because the system is designed to make it grow. Whether that growth improves life for the majority is no longer part of the calculation. Economic growth does not disappear. It is not lost, wasted, or destroyed. It is collected. The central question of modern capitalism is no longer whether value is created, but who ultimately captures it. When people ask why they feel poorer despite expanding economies, the answer is not abstract or mysterious. The growth is real. It is simply flowing in one direction. In earlier economic systems, growth was tightly linked to labor. Expanding production required more workers. More workers meant higher aggregate wages, rising consumption, and broader participation in prosperity. That mechanism has been systematically dismantled. Technological efficiency, globalization, financialization, and market concentration have broken the connection between output and income distribution. Growth now accumulates where ownership resides, not where work is performed. Corporate profit shares of national income have risen steadily across advanced economies, while labor shares have declined. This is not a cyclical fluctuation, but a structural trend observed over decades. Even as productivity improves, wages fail to keep pace. The difference is captured by capital. Shareholders benefit from higher margins, while workers absorb cost pressures through stagnant pay and eroded benefits. Economic expansion becomes asymmetric by design. Market concentration accelerates this process. Entire sectors are dominated by a small number of firms with pricing power, political influence, and global reach. These corporations are not merely participants in growth. They shape its distribution. When competition weakens, firms can raise prices without increasing wages, extract rents, and suppress labor bargaining power. Growth becomes a function of market dominance rather than innovation or efficiency. Financial markets amplify this dynamic. Corporate success is increasingly measured by stock performance rather than long-term value creation. Executives are incentivized through equity compensation, tying their personal wealth directly to share price appreciation. This encourages strategies that maximize short-term valuation, even if they undermine long-term economic health. Cost-cutting replaces investment. Layoffs boost earnings per share. Share repurchases inflate prices without expanding productive capacity. Share buybacks have become one of the most powerful mechanisms through which growth is redirected upward. Instead of reinvesting profits into research, infrastructure, or wages, corporations return capital to shareholders. These transactions increase market capitalization and gross domestic product while bypassing the real economy. The gains accrue to asset owners, not employees or consumers. Growth exists, but it circulates within financial markets rather than flowing outward. Globalization further intensifies this concentration. Supply chains are optimized for cost minimization, often at the expense of domestic labor. Production is relocated to regions with lower wages and weaker protections, while profits are repatriated to corporate headquarters and shareholders. Consumers may benefit from cheaper goods, but workers face downward pressure on wages and job security. The savings generated by globalization do not translate into shared prosperity, they translate into higher margins. Tax structures reinforce this imbalance. Capital gains, dividends, and corporate income often receive preferential treatment compared to wages. Wealth compounds faster than labor income. Those who own assets experience exponential growth, while those who rely on salaries experience linear stagnation. Over time, this divergence becomes self-reinforcing. Wealth generates influence, influence shapes policy, and policy protects wealth. Real estate plays a particularly destructive role in this process. Rising property values are celebrated as economic growth, yet they function as a transfer mechanism from non-owners to owners. Rent increases boost measured output while eroding disposable income. Housing appreciation creates paper wealth for those already inside the market, while permanently excluding those outside it. Growth concentrates in land ownership, not productivity. Global financial institutions, such as World Bank and International Monetary Fund, routinely highlight aggregate growth metrics while acknowledging, often quietly, that inequality undermines social stability. Yet their frameworks remain anchored in expansion rather than distribution. Growth is treated as a prerequisite for inclusion, even when evidence shows that inclusion no longer follows growth. Investment flows reveal the same pattern. Capital seeks returns, not employment. Money flows into assets that promise appreciation rather than industries that create jobs. Technology platforms scale globally with minimal labor input. Financial engineering outperforms manufacturing in profitability. The economy rewards those who control capital allocation, not those who generate output. This redistribution is not accidental. It is embedded in governance structures, corporate law, monetary policy, and global trade architecture. Central banks support asset prices to maintain financial stability, indirectly benefiting those who hold assets. Low interest rates inflate valuations while penalizing savers. Monetary expansion stabilizes markets but widens wealth gaps. Growth is stabilized at the top while precarity expands below. The consequence is a dual economy. One layer experiences compounding gains, asset appreciation, and financial security. The other experiences rising costs, fragile employment, and dependence on credit. Both exist within the same growth statistics. Gross domestic product rises, yet economic reality fragments. Growth does not vanish, it accumulates, and it accumulates precisely where ownership, leverage, and influence intersect. As this concentration accelerates, the social consequences become increasingly visible. Yet the economic system continues to interpret them as side effects rather than signals of structural imbalance. Growth statistics remain positive while participation narrows. The economy expands, but the circle of beneficiaries contracts. One of the most overlooked mechanisms in this process is the separation between income and ownership. For the majority of the population, income is tied to labor, hours worked, and contractual stability. For a shrinking minority, income is tied to asset ownership, price appreciation, and leverage. These two income streams behave fundamentally differently. Labor income is capped by time, physical limits, and bargaining power. Capital income scales automatically. It grows while its owner sleeps, compounds without additional effort, and benefits disproportionately from monetary expansion and policy intervention. As ownership becomes more concentrated, so does the ability to extract value without creating it. Rent-seeking replaces productivity as the dominant growth engine. Fees, tolls, subscriptions, interest payments, licensing costs, and intermediated services multiply across the economy. Each layer adds to gross domestic product while subtracting from household purchasing power. Growth becomes a function of friction rather than efficiency. The digital economy exemplifies this shift. Platform-based firms generate enormous valuations with relatively small workforces. Their dominance allows them to set terms for labor, suppliers, and consumers simultaneously. Gig work expands flexibility for corporations while transferring risk to workers. Employment numbers remain stable on paper, but income volatility increases. The economy grows, yet financial security declines. This model also reshapes investment priorities. Capital increasingly flows toward assets that benefit from scarcity rather than abundance. Housing, land, intellectual property, and financial instruments attract disproportionate investment because they generate predictable returns through exclusion. Scarcity becomes profitable. Affordability becomes irrelevant. Growth rewards limitation, not expansion of access. Pension funds, sovereign wealth funds, and institutional investors participate in this cycle, often unintentionally. In search of yield, they allocate capital to real estate, infrastructure monopolies, and private equity. These investments generate stable returns for beneficiaries, but often rely on cost extraction from the broader population. Higher tolls, higher rents, and reduced services appear as efficiency gains in financial reports, while functioning as hidden taxes on everyday life. Debt acts as the transmission mechanism that allows this system to persist. As incomes fail to keep pace with costs, households borrow to maintain living standards. Credit masks stagnation. Consumption continues even when purchasing power does not. This sustains growth figures while embedding vulnerability. Debt transforms future income into present demand, inflating economic output today at the cost of tomorrow's stability. Corporations follow a similar logic. Instead of expanding capacity or raising wages, they leverage balance sheets to enhance returns. Cheap credit finances acquisitions, buybacks, and financial restructuring. These actions elevate share prices and executive compensation while increasing systemic risk. Growth accelerates without strengthening the underlying economy. Governments, constrained by political cycles and fiscal optics, often reinforce this dynamic. Policies that support asset prices are framed as stability measures. Rising markets are interpreted as public confidence. Declining markets are treated as emergencies. The interests of asset holders align closely with macroeconomic targets, while the lived reality of wage earners remains secondary. Growth is defended even when it becomes socially corrosive. Internationally, the same pattern repeats. Capital flows toward regions that offer financial openness, legal protection, and return on investment, not necessarily toward those that need development. Profits are extracted globally, while risks remain localized. Emerging economies experience growth spurts driven by capital inflows, followed by instability when conditions reverse. The gains accrue to global investors. The losses are absorbed domestically. Inequality is often discussed as a moral issue, but it is fundamentally an economic one. When growth concentrates excessively, it undermines its own foundation. Demand weakens because purchasing power erodes. Productivity suffers because human capital is underinvested. Social cohesion deteriorates, increasing political risk. Yet the system continues to prioritize short-term valuation over long-term resilience. The paradox is that this model appears successful by its own metrics. Corporate profits rise, markets climb, gross domestic product expands. But these indicators increasingly measure extraction rather than creation. They reflect the velocity of money within financial circuits, not the health of the real economy. Growth has not failed to reach people by accident. It has been redirected by structure, incentives, and policy. It flows toward ownership, scale, and leverage because that is where the system channels it. Until distribution becomes as central as expansion, growth will continue to accumulate upward while leaving the majority feeling excluded from the prosperity they are told exists. This is not a temporary distortion. It is the defining feature of the modern economic landscape. Inflation is often described as a temporary disturbance, a technical imbalance between supply and demand, or an unfortunate side effect of economic shocks. In reality, it has become one of the most powerful structural forces reshaping modern societies. It does not simply raise prices. It redistributes wealth, rewrites social contracts, and silently determines who moves forward and who falls behind. While growth statistics remain positive, inflation ensures that much of that growth never reaches households in a meaningful way. At its core, inflation functions as a hidden tax. Unlike explicit taxation, it does not require legislation or public approval. It operates automatically, eroding purchasing power year after year. Those who live primarily on wages and fixed incomes feel its effects immediately. Those who hold appreciating assets often benefit from it. This asymmetry is not incidental. It is the result of how money enters the economy and where it ultimately settles. In recent years, inflation has re-emerged as a global phenomenon. Energy shocks, supply chain disruptions, geopolitical tensions, and expansive monetary policy have all contributed. Yet focusing on these triggers misses the deeper mechanism. Prices did not rise evenly. Essential costs increased faster than discretionary ones. Housing, food, healthcare, education, and transportation absorbed a disproportionate share of household income. These categories dominate everyday life, meaning real inflation for most people far exceeded official averages. Official inflation measures rely on weighted baskets designed to represent the average consumer. In practice, they understate lived reality. Housing costs are often diluted through methodological adjustments. Substitution effects assume consumers can simply switch to cheaper alternatives, even when no real substitutes exist. Healthcare inflation is smoothed over despite rising out-of-pocket expenses. The result is a statistical calm that contradicts daily experience. Wage growth rarely keeps pace with this form of inflation. Even when nominal wages rise, purchasing power often declines. Salary increases are episodic and negotiated infrequently. Prices adjust continuously. This lag creates a permanent gap. Workers are told they received raises, yet their standard of living deteriorates. Inflation does not need to be extreme to cause damage. Sustained, moderate inflation quietly accomplishes the same outcome over time. Asset holders experience a different reality. Inflation inflates nominal asset values. Real estate prices rise alongside rents. Equity markets adjust upward as companies pass higher costs onto consumers. Debt becomes easier to service in real terms. Those with leverage benefit as the real value of liabilities declines. Inflation transfers wealth from savers to borrowers, from renters to owners, from labor to capital. Monetary policy plays a central role in this redistribution. Central banks respond to crises by expanding liquidity to stabilize financial systems. This liquidity enters the economy through financial institutions and asset markets first. Prices of stocks, bonds, and property respond quickly. Wages do not. By the time inflation reaches consumer goods, asset owners have already adjusted. The sequence matters. Early recipients benefit, late recipients pay. Institutions, such as the Federal Reserve, the European Central Bank, and the Bank of England, emphasize price stability while simultaneously prioritizing financial stability. In practice, this means protecting asset markets during downturns while tolerating gradual erosion of purchasing power. Inflation becomes acceptable as long as markets function and debt remains serviceable. Housing illustrates the destructive efficiency of this process. Rising property prices are recorded as economic strength. Construction, financing, brokerage, and legal services all add to gross domestic product. Yet, affordability collapses. Rent consumes a growing share of income. Homeownership shifts from a social norm to a speculative asset class. Younger generations are locked out, not by lack of effort, but by price dynamics detached from wages. Energy inflation follows a similar pattern. Higher energy prices raise transportation, production, and utility costs across the economy. Corporations pass these costs on. Governments record higher nominal output. Households absorb higher bills. Inflation registers as growth, while functioning as extraction. Globally, inflation amplifies inequality between countries. Nations with reserve currencies can export inflation through monetary expansion. Capital flows absorb excess liquidity. Developing economies import price instability through higher commodity costs and capital volatility. Their currencies weaken, making essential imports more expensive. Growth in global output masks divergence in living standards. Inflation also reshapes behavior. Long-term planning becomes risky. Saving loses meaning. Speculation appears rational. Households are pushed toward riskier assets simply to preserve value. Financial literacy becomes a survival skill rather than an advantage. Those unable or unwilling to participate fall behind regardless of effort. The psychological impact is profound. Inflation erodes trust in institutions and statistics. When official numbers contradict lived experience, credibility collapses. People sense decline even when told growth is strong. This gap fuels political instability, social polarization, and distrust of expertise. Inflation is not merely an economic variable, it is a social force. What makes inflation particularly effective as a redistributive mechanism is its opacity. There is no single moment of loss, no explicit deduction, just gradual erosion. By the time it becomes visible, adjustment has already occurred. Contracts are renegotiated downward, expectations reset. The new, lower standard becomes normal. Inflation does not simply accompany modern growth, it enables it. It allows economies to expand nominally, while real burdens shift quietly onto households. It sustains debt-driven systems by reducing real obligations. It preserves the appearance of prosperity while hollowing out its substance. Growth continues. Prices rise, people fall behind, and the system records success. As inflation becomes embedded rather than episodic, its role shifts from disturbance to structural stabilizer. It quietly performs tasks that political systems struggle to execute openly. It reduces real wages without renegotiation. It lowers the real value of public and private debt without default. It reallocates resources without legislation. In doing so, it becomes one of the most efficient tools for maintaining a growth model that would otherwise face resistance. One of the most consequential effects of sustained inflation is its impact on savings. Traditional saving, once a cornerstone of financial security, becomes irrational. Cash loses value. Fixed income instruments fail to preserve purchasing power. Households are forced into a dilemma: accept slow erosion or assume risk. This shift fundamentally alters financial behavior. Risk-taking is no longer a choice driven by opportunity, but a necessity driven by preservation. Markets absorb capital not because people seek returns, but because they fear stagnation. This dynamic disproportionately benefits those already positioned within the financial system. Access to diversified portfolios, leverage, and professional management allows asset holders to hedge inflation effectively. Those without such access face exposure without protection. Inflation thus widens the gap not only between rich and poor, but between financially integrated and financially excluded population. Economic participation becomes a prerequisite for stability, not advancement. Labor markets reflect this pressure in subtle ways. Workers demand higher wages to keep pace with rising costs, but bargaining power remains constrained. Global labor pools, automation, and contractual precarity limit wage acceleration. Employers, facing inflation themselves, resist increases while preserving margins through price adjustments. The burden shifts downward. Real compensation declines even as employment remains nominally strong. Stability replaces progress as the best achievable outcome for many. Inflation also reshapes corporate strategy. Companies adapt by prioritizing pricing power over volume. Subscription models, dynamic pricing, and fee-based structures proliferate because they allow rapid adjustment to inflationary pressures. These mechanisms stabilize revenues while transferring volatility to consumers. Growth persists, but it is sustained through extraction rather than expansion. Firms that lack pricing power consolidate or disappear, further increasing market concentration. Governments face their own inflationary calculus. Fiscal pressure intensifies as debt servicing costs rise. Rather than implement politically costly austerity or explicit tax increases, inflation offers a quieter alternative. Public debt shrinks in real terms. Revenues rise automatically as nominal incomes and prices increase. Expenditures lag behind inflation due to bureaucratic inertia. The state benefits from the same lag that harms households. This creates a paradox. Governments publicly commit to fighting inflation while structurally benefiting from its persistence. Tightening measures are calibrated to prevent runaway price instability without restoring purchasing power fully. The goal becomes control, not elimination. Inflation is managed, not resolved. Central bank credibility rests on this balance. Institutions maintain legitimacy by preventing hyperinflation while tolerating steady erosion. Interest rate adjustments signal action, but structural drivers remain intact. Monetary tightening often arrives after inflation has already redistributed wealth. Damage is acknowledged but not reversed. Stability is restored at a lower baseline. Internationally, inflation reinforces global hierarchies. Countries with strong currencies and deep capital markets absorb inflation through asset appreciation. Countries without such buffers experience currency depreciation, capital flight, and imported inflation. Their populations face higher prices without compensating asset gains. Growth metrics may remain positive, but social strain intensifies. Inflation also distorts innovation incentives. Short-term financial performance becomes more attractive than long-term productive investment. Inflation rewards speed and leverage over patience and development. Research, infrastructure, and human capital investment struggle to compete with assets that adjust automatically to price increases. The future is discounted more aggressively. The cumulative effect is a redefinition of prosperity. Stability replaces improvement. Survival replaces aspiration. People adjust expectations downward, not because conditions demand it, but because inflation normalizes decline. What once felt like loss becomes routine. The system adapts by lowering the standard rather than correcting the cause. Inflation does not merely accompany economic growth in the modern era, it underwrites it. It allows economies to appear dynamic while quietly shifting costs onto those least able to bear them. It reconciles expanding gross domestic product with declining lived experience. By the time inflation becomes politically intolerable, its work is largely complete. Wealth has been reallocated, debts have been diluted, behavior has adapted. The economy moves forward statistically, leaving behind a population that feels poorer, more anxious, and increasingly disconnected from the growth it is told exists. This is how inflation sustains a system that grows without enriching. Modern economic growth has become inseparable from debt. This is not a temporary policy choice or an emergency response. It is a structural dependency. Without continuous expansion of credit, contemporary economies struggle to function, markets destabilize, and growth narratives collapse. Debt is no longer a tool used occasionally to smooth cycles. It is the foundation upon which expansion itself rests. In earlier economic eras, debt played a supporting role. It financed investment, bridged productive gaps, and accelerated development. Growth eventually reduced relative debt burdens as incomes and output expanded faster than liabilities. That relationship has reversed. Today, growth requires ever-increasing levels of borrowing simply to sustain existing activity. Debt does not follow growth. Growth follows debt. This shift is visible across all sectors. Households rely on credit to access housing, education, healthcare, and even basic consumption. Corporations depend on leverage to meet shareholder expectations and maintain competitiveness. Governments finance structural deficits through borrowing rather than taxation. At every level, the system substitutes future income for present stability. Household debt illustrates the human cost of this transformation. Rising living expenses outpace wage growth, forcing families to borrow not to improve their standard of living, but to preserve it. Mortgages grow larger relative to income. Student loans extend further into adulthood. Consumer credit fills the gap between stagnant wages and rising costs. Debt becomes a requirement for participation, not a strategy for advancement. This dependency alters behavior. Financial risk is normalized. Long-term obligations are accepted early in life. Economic mobility becomes contingent on creditworthiness rather than productivity or skill. Those unable to access debt are excluded. Those who can access it remain perpetually leveraged. Growth appears stable because consumption continues, but it is sustained by obligation rather than income. Corporate balance sheets reveal a similar pattern. Cheap and abundant credit encourages financial optimization over productive expansion. Instead of investing in capacity, training, or innovation, firms borrow to restructure capital. Acquisitions replace organic growth. Buybacks replace wage increases. Debt enhances returns on equity while increasing fragility. Profits rise, but resilience declines. Low interest rate environments reinforce this behavior. When borrowing costs are suppressed, leverage appears rational. Returns are amplified. Risk is discounted. As long as asset prices rise, debt is perceived as manageable. This creates a feedback loop. Rising valuations justify more borrowing, which further inflates valuations. Growth accelerates without strengthening the underlying economy. Governments rely on debt to maintain social and economic stability. Fiscal deficits become permanent rather than cyclical. Public spending expands to compensate for private sector weaknesses, aging populations, and social pressures. Borrowing replaces reform. Debt postpones political trade-offs. Growth is preserved statistically while structural issues deepen. Global debt levels have reached unprecedented proportions relative to output. This is not confined to a single region or development stage. Advanced economies carry massive public liabilities. Emerging economies accumulate external debt to finance growth. The entire system is synchronized around leverage. Debt expansion becomes a global requirement, not a local choice. Central banks play a pivotal role in sustaining this architecture. By acting as lenders of last resort and stabilizers of financial markets, they reduce the immediate cost of risk. Market participants internalize this support. Leverage increases because downside is perceived as limited. Monetary policy evolves from managing inflation to managing debt sustainability. Institutions such as the Bank for International Settlements, the International Monetary Fund, and the World Bank repeatedly warn about rising debt burdens, while simultaneously supporting frameworks that depend on continued borrowing. Debt is framed as manageable as long as growth persists. Growth persists as long as debt expands. The circularity is complete. This model carries inherent instability. Debt amplifies both expansion and contraction. When conditions tighten, servicing costs rise faster than incomes. Households reduce spending, corporations cut investment, governments face fiscal stress. Growth slows, threatening the very mechanism used to sustain it. The response is more borrowing, deeper intervention, and further entrenchment. The illusion of sustainability is maintained through refinancing rather than repayment. Old debt is rolled into new debt, maturities extend, obligations are restructured, default are delayed. As long as credit markets function, the system appears stable, but stability is contingent, not structural. Debt also reshapes power dynamics. Creditors gain influence, debtors lose flexibility. Economic policy prioritizes market confidence over social outcomes. Decisions are filtered through their impact on yields, ratings, and capital flows. Growth becomes something that must be signaled to markets rather than delivered to people. The most profound consequence of debt-driven growth is temporal. It pulls future resources into the present. It accelerates consumption without increasing capacity proportionally. It leaves future generations with obligations they did not choose. Growth today is purchased with constraints tomorrow. Yet within current metrics, this model appears successful. Output expands, employment holds, markets function, gross domestic product grows. The cost is deferred, invisible in headline numbers. Debt allows economies to grow without resolving underlying distributional and productivity challenges. This is not a malfunction. It is the logical outcome of a system that prioritizes continuity over correction. Debt becomes the mechanism through which imbalance is sustained rather than addressed. Growth persists not because fundamentals improve, but because borrowing fills the gap. The modern economy does not collapse under debt. It depends on it. As debt deepens its role, the system adapts to protect it, even when doing so undermines long-term resilience. Economic policy becomes less about improving productivity and more about preventing deleveraging. The fear is not recession itself, but the cascade of defaults that would follow if debt growth were interrupted. Stability is redefined as the uninterrupted servicing of obligations rather than the improvement of living standards. This fear reshapes monetary behavior. Interest rates become political instruments as much as economic ones. Raising rates threatens borrowers across households, corporations, and governments simultaneously. Lowering rates inflates asset prices and encourages further leverage. Central banks are trapped between inflation control and debt sustainability. Their actions signal restraint while quietly accommodating leverage. Markets learn to interpret any tightening as temporary. Financial markets internalize this expectation. Risk premiums compress, volatility declines artificially, capital becomes mispriced. Investments that would be unsustainable under normal conditions persist because refinancing is assumed. This environment rewards scale and leverage. Smaller firms without access to cheap credit struggle to compete. Market concentration accelerates further, reinforcing the upward flow of growth. Debt also distorts innovation. Truly transformative investment requires time, uncertainty, and patience. Leveraged systems favor projects with predictable cash flows that can service debt quickly. Infrastructure that generates tolls is preferred over public goods. Intellectual property that produces licensing fees outperforms open innovation. Growth becomes narrower, optimized for financial extraction rather than societal benefit. The labor market absorbs these distortions unevenly. As firms prioritize financial stability, labor becomes a variable cost to manage rather than a resource to develop. Contract work expands, benefits shrink. Employment remains statistically strong, but security weakens. Workers shoulder volatility, so balance sheets remain intact. Growth persists, but its risks are redistributed downward. Debt-driven growth also changes how crises are handled. Economic shocks no longer reset systems, they entrench them. Each crisis justifies larger interventions to preserve stability. Emergency measures become permanent features. Liquidity injections normalize. Balance sheets expand. What begins as temporary support becomes structural dependence. The system survives, but only by increasing its sensitivity to future shocks. Globally, this architecture synchronizes economies and vulnerability. When borrowing costs rise in one major financial center, capital flows shift worldwide. Emerging markets experience sudden tightening. Currencies depreciate. Debt denominated in foreign currencies becomes harder to service. Growth reverses rapidly. The gains of prior expansion evaporate while obligations remain. International coordination attempts to manage this risk without addressing its cause. Swap lines, emergency lending, and stabilization programs preserve market function. They prevent collapse, but they do not reduce leverage. Debt is stabilized, not resolved. Growth resumes, but on weaker foundations. The political consequences are profound. Economic policy becomes constrained by market reaction. Democratic choices narrow. Redistribution is avoided because it threatens confidence. Structural reform is postponed because it introduces uncertainty. Debt disciplines politics. Governments govern within the limits set by creditors rather than citizens. This creates a legitimacy gap. People sense that policy no longer serves them, yet alternatives appear risky. Stability is prioritized over fairness. Growth is defended even as its benefits shrink. The system becomes self-preserving, resistant to change, because change threatens the debt structure that holds it together. The intergenerational dimension is unavoidable. Debt shifts burden forward. Future incomes are pledged before they are earned. Public investment competes with debt servicing. Younger generations inherit obligations alongside inflated asset prices. Mobility declines. Opportunity narrows. Growth figures remain positive, but social momentum reverses. The paradox is that debt-driven growth feels necessary because the system has adapted to it. Removing debt would expose imbalances that have accumulated for decades. Productivity gaps, inequality, underinvestment, and demographic pressure would surface simultaneously. Debt delays confrontation by spreading cost across time, yet delay increases magnitude. Each cycle of borrowing raises the threshold at which adjustment becomes unavoidable. When correction arrives, it will not be gentle. Debt magnifies outcomes in both directions. The longer expansion is sustained through leverage, the sharper contraction becomes when leverage fails. From a purely financial perspective, the model is rational. It maximizes continuity. It minimizes immediate pain. It preserves asset values. From a societal perspective, it is corrosive. It replaces progress with postponement. It trades resilience for appearance. It allows economies to grow without becoming stronger. Debt does not merely support modern growth, it defines it. It determines what kind of growth is possible and who bears its risks. Until growth can occur without expanding leverage, prosperity will remain conditional, fragile, and unevenly distributed. The economy moves forward by borrowing from its own future and calls that progress. By the time the consequences of this system become visible to the majority, the system itself is already locked in. The persistence of a growth model that leaves most people poor is not the result of ignorance or incompetence. It is the result of incentives. Modern economic structures reward the appearance of stability, continuity, and expansion far more than they reward broad prosperity. Fixing the problem would require changing the metrics, the priorities, and the power structures that benefit from the current arrangement. That is precisely why it does not happen. Political systems are deeply aligned with headline growth. Gross domestic product functions as a universal scorecard. It is simple, comparable, and easily communicated. Rising output signals competence. Falling output signals failure. Elections, budgets, and international standing all hinge on this number. Any policy that risks slowing growth, even temporarily, becomes politically toxic, regardless of its long-term benefits. Structural reform is sacrificed to quarterly optics. Markets reinforce this bias relentlessly. Financial markets demand predictability. Investors price assets based on expectations of future cash flows, policy stability, and continued expansion. When governments pursue redistribution, regulation, or structural change, uncertainty rises. Capital reacts immediately. Asset prices fall. Borrowing costs increase. Leaders learn quickly that markets tolerate inequality far more than unpredictability. Growth is protected because it protects valuations. This dynamic turns economic policy into risk management for capital rather than strategy for society. Decisions are filtered through their impact on yields, equity indices, and credit ratings. Public officials may speak about inclusion, fairness, and opportunity, but their operational constraints are defined by market reaction. Growth becomes the language spoken to investors, not citizens. Institutional inertia compounds this effect. Large organizations, from finance ministries to central banks to international forums, are built around existing frameworks. Their models, forecasts, and mandates assume growth as the primary objective. Alternatives exist, but they are treated as academic or experimental. Changing the core metric would require rewriting mandates, retraining institutions, and admitting past misalignment. Bureaucracies rarely reward self-correction at that scale. Global coordination further entrenches the status quo. In an interconnected system, deviation carries penalties. A country that prioritizes redistribution over growth risks capital flight. A government that challenges financial dominance risks currency pressure. The threat is not theoretical. It is enforced daily through capital flows. Conformity becomes rational. The global economy behaves like a synchronized machine, punishing outliers and rewarding compliance. Elite capture ensures continuity. Those who benefit most from the current system also possess the greatest influence over policy, media, and narrative. Wealth funds lobbying, think tanks framing debate, media emphasizing market performance over material conditions. The story of growth persists because it serves those who tell it. Alternatives struggle to gain traction not because they lack merit, but because they lack amplification. The financial sector plays a central role in this preservation. Its profitability depends on volume, leverage, and activity. Slower growth means fewer transactions, lower fees, reduced valuations. Stability in this context does not mean social balance. It means uninterrupted flows. Financial institutions do not oppose reform out of malice, but out of alignment. Their survival depends on the system continuing as it is. International gatherings, such as those organized by the World Economic Forum, openly acknowledge inequality, stagnating wages, and social fragmentation. Yet proposed solutions rarely challenge the growth paradigm itself. Instead, they focus on inclusion within the existing model. More access, more participation, more resilience. The structure remains intact. The distribution remains secondary. This is because the current system solves problems that policymakers care about most. It finances governments without raising visible taxes. It stabilizes debt without default. It keeps markets functioning. It postpones crisis. These outcomes are politically valuable, even if socially corrosive. Growth that enriches a minority is still growth that keeps the machine running. There's also a cognitive dimension. For decades, growth has been synonymous with progress. Questioning it feels like regression. Leaders fear being associated with decline, even if that decline is only statistical. Proposing a slower but fairer economy sounds like surrender in a culture obsessed with expansion. The narrative is deeply embedded. Technology intensifies this reluctance. Automation, artificial intelligence, and platform economies promise future productivity gains. Policymakers defer hard choices by pointing to coming innovation. Growth is always just ahead. Distribution can wait. The future is used as justification for present imbalance. The public, meanwhile, experiences fragmentation. Individual struggles feel personal rather than systemic. Debt, inflation, insecurity are internalized as failures rather than outcomes. Without a shared framework to understand the structure, collective pressure weakens. Growth remains unchallenged because its costs are diffused, while its benefits are concentrated. Even when discontent becomes visible, it is often redirected. Cultural conflicts replace economic ones. Symptoms are debated instead of causes. Growth is defended as neutral, while inequality is framed as unfortunate but inevitable. The system adapts rhetorically without adapting structurally. From the perspective of an investor or policymaker focused on stability, the logic is coherent. Growth supports asset values. Asset values support confidence. Confidence supports investment. Investment supports growth. Breaking this loop introduces risk. Maintaining it concentrates reward. The choice is rarely debated explicitly because it is embedded implicitly in every incentive. The truth is uncomfortable. The system is not failing to fix the problem. It is succeeding at preserving itself. Growth continues not because it improves life for most people, but because it sustains the structures that govern modern economies. Until success is defined differently, nothing fundamental changes. The question then becomes not whether the system could change, but under what conditions it would be forced to. History suggests that entrenched economic structures do not evolve voluntarily. They adapt rhetorically, absorb criticism, and reframe objectives, but they rarely surrender the incentives that sustain them. Change arrives only when the cost of preservation exceeds the cost of transformation. Until that threshold is reached, growth remains the preferred illusion. One reason this threshold is so distant lies in how pain is distributed. The burdens of the current model are fragmented across populations, generations, and geographies. Inflation erodes slowly. Debt accumulates quietly. Opportunity narrows incrementally. There is no single moment of collapse, only gradual compression. This diffusion prevents coordinated response. People experience decline individually, while growth is celebrated collectively. The asymmetry weakens pressure for reform. Economic discourse further neutralizes urgency. Complex language obscures responsibility. Structural outcomes are framed as technical necessities. Models replace moral questions. When outcomes are presented as inevitable consequences of globalization, technology, or demographics, accountability dissolves. Growth becomes fate rather than choice. Debate shifts from what should be done to what can be managed. Even data reinforces complacency. Aggregate indicators remain strong long after underlying conditions deteriorate. Employment numbers hide underemployment. Income statistics ignore cost inflation. Wealth averages conceal concentration. Policymakers rely on dashboards that signal health, while households feel strain. By the time indicators turn negative, damage is already deep. There is also a generational disconnect. Younger cohorts face higher barriers to stability, but they lack accumulated political power. Older cohorts benefit from asset appreciation and policy inertia. Growth that preserves asset values aligns with their interests. Policy reflects participation, not need. The future bears the cost of choices made in the present. International comparison sustains the narrative as well. As long as peers face similar challenges, decline feels normalized. Relative positioning matters more than absolute well-being. If everyone is growing, no one appears to be failing. Global stagnation becomes a shared baseline rather than a call to action. Institutions tasked with long-term thinking often lack enforcement power. Reports acknowledge risks, panels warn of inequality, forecasts model instability, but recommendations stop short of challenging core incentives. Redistribution is suggested cautiously. Structural reform is postponed. Growth remains the anchor. Organizations such as the Organization for Economic Cooperation and Development publish extensive analysis on declining mobility, wage stagnation, and concentration of wealth, yet policy alignment remains limited. The diagnosis is clear. The treatment is avoided. Knowledge accumulates without translation into action. Crises appear to offer opportunity, but even they reinforce the system. Financial shocks justify intervention to stabilize markets. Public resources are deployed to preserve existing structures. Emergency becomes precedent. Each rescue strengthens the expectation of future support. Risk is socialized. Reward remains private. Growth resumes, but dependency deepens. Technological optimism further delays reckoning. Artificial intelligence, automation, and digitalization are framed as future solutions that will eventually lift productivity and wages. This promise defers redistribution. If abundance is coming, patience is required. If disruption is necessary, inequality is transitional. The narrative persists, regardless of outcomes. Yet beneath these narratives, constraints tighten. Social trust erodes. Political polarization intensifies. Labor participation weakens. Health outcomes diverge. These are not external to the economy. They are signals of systemic strain. Growth that ignores them compounds fragility. At some point, maintenance becomes more expensive than reform. Debt servicing crowds out investment. Asset inflation destabilizes consumption. Demographic shifts reduce labor supply. Climate pressure raises costs. Geopolitical fragmentation disrupts flows. Growth slows not because ambition fades, but because structure resists adaptation. When that moment arrives, options narrow. Adjustment can be deliberate or chaotic, managed transition or forced correction. The longer reform is delayed, the harsher the eventual response. History favors abrupt change over gentle evolution when incentives remain misaligned. The final irony is that a system designed to avoid instability may ultimately produce it. By prioritizing continuity over equity, expansion over resilience, and metrics over experience, modern growth undermines the foundation it depends on. Confidence erodes not because people misunderstand the economy, but because they live within its consequences. The economy does not collapse suddenly, it loses legitimacy first. Growth numbers continue, markets function, but belief weakens. When belief disappears, stability follows. Until success is redefined beyond output, beyond valuation, beyond expansion for its own sake, the world will continue to grow statistically while feeling poorer in reality. The system will persist, not because it works for most people, but because it works for itself. If this video changed how you see the economy, do not let the conversation end here. Question the numbers you are shown. Look past growth headlines. Pay attention not to what expands, but to who benefits. Share this with someone who feels the pressure but cannot explain why. Subscribe if you want economics without slogans, without comfort stories, and without illusions. Because the most dangerous belief in modern society is not that the economy is collapsing. It is the belief that this is the best it can do.